Hi, this is Rowland for Money Markets TV. I hope you all had a happy Thanksgiving. For many people, the holidays is much about gluttony as it is about spending time with family. In that sense, Thanksgiving has something in common with my field of expertise, exchange-traded funds. U.S. investors can now choose from among 1,374 listed ETFs and ETNs. The list includes 18 large cap growth funds, 91 U.S. large cap funds, 50 technology sector funds, 54 U.S. Treasury funds, 30 VIX funds, 28 precious metals funds, and 79 energy funds. I believe choice and competition ultimately work to the benefit of investors, but just like your leftover turkey, these duplicative ETFs won't last forever. Some will need to be recycled. Every month, my ETF Death Watch keeps a running tab on endangered funds. Some sponsors have told me in no uncertain terms that they don't appreciate the honor of making my list. Well, I'm sorry if their marketing plans aren't working, but I compile my Death Watch using totally objective criteria. First, I exclude all ETFs and ETNs launched within the last 6 months. Even good funds need a little time to gain attention. Second, I take out any ETFs with assets greater than $25 million in either of the last 2 months. These funds are big enough to survive on their own. After I've excluded the ETFs that fall into those categories, I'll look for any other remaining funds that either have an average daily value traded of less than $100,000 for the last 3 consecutive months, or have assets under management below $5 million for 3 consecutive months. I think the rules are quite fair. If you're an ETF sponsor and you can't attract $5 million or convince people to buy and sell $100,000 worth of shares on an average day, then your product will not likely survive. At the end of October, my Death Watch list included 154 ETFs and 57 ETNs, a record number. I believe this uptick is due to the flurry of new launches this year, 275 over the first 10 months of 2011. The average age of the funds on the list is 26 months, and they have average assets below $6 million. Yet, their sponsors have announced liquidation plans for only a small handful of them. So, what happens if you're in an ETF when it does liquidate? You're unlikely to have a total loss because you'll get paid your pro rata share of whatever the portfolio is worth on its closure date. On the other hand, smart investors will probably have already sold out by that point. Whoever is left behind may have to bear the fixed cost of the entire fund, which could be significant. Some sponsors even make the few remaining shareholders cover the cost of actually closing the fund. Moreover, since closing funds are typically very small with little activity, the market price is easily gamed by professionals in those last few days. If you own an ETF or ETN on my Death Watch list, should you sell at once? Not necessarily. Quick strike day traders may be able to profit from some of the names on the list, but if you're a long-term investor, these products are probably not worth the risk. I'm Ron Rowland from Money Markets TV. Thank you for watching.